Have you ever wondered how you stack up against other people financially? How does your income compare to everyone else's? And your spending too? It's not uncommon to want to measure your financial situation with others who are in a similar age range or stage of life. These types of statistics give you a baseline to compare to as you assess your own financial health. Whether you are falling behind because of several factors, or are you ahead of the curve with a well-balanced household budget, and it will help you to plan your next financial moves. Pay close attention as some of the financial statistics are quite shocking. According to the Bureau of Labor Statistics, the median weekly income of the U.S. full-time wage and salary workers was about $1,041 per week, or $54,132 per year, including overtime, commission, and tips. These figures are based on median estimates from the government. Salaries can vary significantly based on factors such as education level, occupation, and location. Among all adults, median retirement savings are $65,000, according to the Federal Reserve's most recent data. They further found that only 50% of American families had retirement accounts. Knowing the average retirement savings by age can help you figure out where you stand and how you can be better prepared for the future. Those who are 25 and younger had an average retirement savings balance of $6,264, and median retirement savings balance is $1,786. The average contribution rate was 8%. These statistics are alarming. Although many people younger than 25 years old are new to the workforce or are not in a job where 401k plan is offered, according to the Vanguard study, 56% of those who are eligible for a 401k plan are participating in it. This indicates that this generation is indeed planning for retirement early on. The median retirement savings balance of 25 to 34 years old was $14,068. From 25 to 34 years old is the prime time to start aggressively putting money in your retirement savings, since you have likely been in the workforce for a couple of years at this point. In 2021, 81% of eligible workers in this age group participated in a retirement plan. The median retirement savings balance of 65 plus was $87,725. Although many workers plan to retire at 64, the average retirement age is 62. According to the Vanguard study, only 77% of workers aged 65 and up in 2021 were participating in this plan. Although fewer people are participating, this is still a good time to continue contributing if you're able to. The standard rule of thumb is to save 20% from every paycheck, and investing it will help you improve your financial health. In October 2020, Social Security announced a 1.3% hike in its cost of living adjustments for 2021. For the average retiree, this increase will come out to about $20, making the average monthly benefit amount $1,543 for 2021. If there's nothing saved for retirement, then you will need to supplement your income from a job to boost financial stability. Beneficiaries have the option to delay collecting Social Security beyond their full retirement age. Each year that collection is delayed, the benefits increase until you hit age 70. This is the latest that someone can claim retirement benefits and the age at which those benefits max out. The upside of waiting to collect is that the payout each year will be greater, but you will collect for fewer years. The average monthly expenses among all households are $5,577, or $66,928 annually, according to the Consumer Expenditure Survey from the U.S. Bureau of Labor Statistics. That spending covers everything from major costs such as mortgage payments and groceries to smaller purchases like apparel and entertainment spending. Average monthly spending on housing is $1,885, or 34% of overall spending. Credit scores typically range from 300 to 850. The average American has a credit score of 714 according to data from Experian. That's considered good by FICO's score ranges. Credit scores are numerical ratings of your borrowing and repayment history, commonly used by banks to determine eligibility for loans and interest rates. The higher your score, the better. People with higher credit scores tend to get better interest rates on loans, have access to credit cards with better perks and lower interest rates, and could even pay less for insurance. These are the most common factors that can impact your credit score. The average household's credit card balance is $9,260. One of the worst types of debt you can have is credit card debt. Typically, people with credit card debt are simply overspending, oftentimes on consumer goods. Exceeding your budget on a regular basis not only burdens you with unnecessary debt, but also prevents you from spending that money on savings and investments. Even worse, most credit cards charge interest rates in the high double digits, meaning your debt can rapidly spiral out of control even if you stop overspending. High debt levels also hurt your credit score, making it harder to qualify for low rates on everything from mortgages to auto loans. Generally speaking, debt is something you want to avoid when it comes to your financial life. Debt can act as a drag on your finances because you're forced to divert some of your cash flow to paying interest and principal on that debt. You can follow these strategies to avoid falling into a hole of debt. Your roadmap to building wealth starts with knowing your net worth and making valuable changes like reduced spending, increased saving. In the Federal Reserve's latest survey of consumer finances report, the median household net worth for a head of household age 35 to 44 years old was $91,300. For a head of household age 45 to 54 years old, that figure was $168,600. In the 55 to 64 age range, average net worth is $212,500. Including all age groups, median net worth rose 18% from the 2016 survey to $121,700. Net worth is assets minus liabilities, or you can think of net worth as everything you own, less all that you owe. Total assets will include your investments, savings, cash deposits, real estate. Total liabilities would include any debt, such as student loans, credit card debt, mortgages, personal loans, and other debt. The Federal Reserve listed the average personal savings rate in the U.S. at 6.4%. This means the average American household saves just over half of what they should save. Experts recommend that your personal savings rate should be 10% of your income. Saving money is one of the essential aspects of building wealth and having a secure financial future. It also secures you in a financial emergency. If you want to focus on building wealth, you must save money. When you do so, you develop excellent financial practices and increase your cash reserves. It also helps you invest, which is the only way to build actual long-term wealth.